Hi, I'm Angie Austin with Oil and Gas 360 here at EnerCom's 2018 Oil and Gas Conference, and joining us is Brad Lingo. He is the Managing Director and CEO of Elk Petroleum. Welcome, Brad.
Well, thank you. It's a real pleasure to be here.
Let's talk a little bit of just a quick rundown of your company's core assets, what they are, where they are, and we'll briefly talk about your approach to drilling and developing those assets.
Yep. Elk is a dedicated CO2 EOR production company, specifically focused in the Rockies, and we've got three significant assets in the portfolio. We are the majority owner and operator of the Aneth giant oil field. Aneth was rated by the EIA as the 86th biggest oil field in the United States, and we have that entire field in joint venture with Navajo Nation Oil and Gas. We're 63% owners. Our next biggest asset is we're a 14% non-op working interest owner with Conoco in the Madden gas field. Madden is the second biggest source of CO2 supply for CO2 EOR in the Northern Rockies. So that's why it's critical to us. And then our newest and our newest producing asset is the Grieve CO2 EOR project, where we're in a 51-49 JV with Denbury as the operator. And really looking for that asset to start coming on and producing strong in the not too distant future.
Let's talk a little bit about what you've learned from drilling and producing your assets that maybe has unlocked more of what you can get out of them.
Yeah, I think that's a really good question, particularly for a company like Elk that we're so engineering and technology driven. And one of the good examples of that, we've brought for the first time new monobore well completions into the development of our Aneth operation. First time in our knowledge that the BLM has ever approved this type of well design for operation on federal lands. What did it deliver? It delivers us a highly competent wellbore, one that's purpose-built for CO2 EOR operations, stainless steel completion, ideal for free-flowing wellbore conditions, and we did that all at a cost where we've reduced on a per well basis the total capex by about 50%. That now leads us to providing the full backbone for up to an 80 well infill drilling campaign, which is all about delivering in our business at Aneth another 60 million barrels of PUD into PDP and increasing our current production rate up to 14 to 18,000 barrels a day.
It's impressive. All right, let's talk a little more about technology. What new technologies are you seeing out there, Brad, that are more likely to become commonplace in the oil and gas industry over the next few years?
I think one of the key things that I think has been really important, one is in field redevelopment like we work on is utilization of high resolution 3D seismic. If you can't measure it, you can't manage it. And it's better to be able to see what you want to see before you try to get there. It's almost your map. And then equally, really sophisticated logging. For us, it's all about residual hydrocarbon saturation in the reservoirs that we're looking to produce. And with highly advanced logging, either open hole or through pipe, being able to really get a really good handle on those hydrocarbon saturations, those water saturations, those CO2 saturations as we move through the development of the field. You combine those two things together, the 3D to see where the CO2 is moving to over time, in 4D more or less, and that advanced logging, it's, as I always say, measure twice, cut once. As history has taught me, the most expensive well you ever drill is the one you never should have drilled.
I like these. These are very common sense things, though, that save you a lot of money and make you a lot of money. All right, let's talk a little bit about some good news about the industry coming out of the most recent period of declining oil prices and what's next. Like, what should oil and gas companies be focused on, for instance, in the next few years, in your opinion?
I think, having started my career in oil and gas in the '86 oil crash, I think as oil prices recover, the one thing we always have to keep in mind is capital discipline. Only get exuberant if exuberance is justified. So first and foremost, just because the oil price has gone up doesn't mean go after marginal assets or go after marginal projects. Even though they may look economic today, the oil price, as we know, can turn on you just as quickly. So I say that's the first lesson. The second lesson is really to focus on those highest quality projects that you have in your portfolio, whether it's a drilling project, whether it's a compression project, to be able to bring on those highest value barrels to capture the highest value commodity price. And that's very much what we're focused on right now. Really going after low-hanging fruit projects in our portfolio that were deferred but prepared for when oil prices went down. So we're actually ready to capture the benefit of those projects in the commodity price recovery.
Well, let's talk a little bit about takeaway, Brad. What's the primary message that you want people to take away from your presentation at the conference this year?
I think the main message is that Elk is a rapidly growing, newly emerging player in CO2 EOR across the Rockies. Very few people knew about us in 2015, and with us acquiring majority ownership and operation of ANF, one of the three biggest CO2 EOR projects in the Rockies, and being able to raise and attract the necessary capital to do that when the only other players getting money were in the Permian, shows the strength of our business. But more importantly, one of the key messages that we'll show in the presentation is that CO2 EOR can be, in the right asset, with the right operator, low risk, high growth, and high margin. And that's not a very common mix. When people start really getting a hold of that, they'll, I think, find Elk a very attractive investment proposition.
And a good message there too. Thank you, Brad. Brad Lingo, Managing Director and CEO of Elk Petroleum. I'm Angie Austin for Oil and Gas 360.
Thank you very much.